So guys, in this session, we'll be learning the basics of accounting. In this session, we'll understand what is accounting, why do we need accounting, and a few basic terms related to accounting. So let's begin. Firstly, what is accounting? What do we mean by the term accounting? Accounting is one of the key functions of almost every business. It may be handled by a bookkeeper or an accountant at a small firm or by sizable financial departments with dozens of employees at large companies. But accounting plays a very important role in every business. It is a process of recording financial transactions of a business and also includes summarizing, analyzing, and reporting these financial transactions in the form of financial statements. So, first we collect the data, we summarize it, we analyze the data, and prepare financial information based on the data we have. So, in simple words, we can say that accounting is the process of recording and summarizing financial information and use that information to do further analysis and prepare financial statements based on the data we have. So now that we have understood what is accounting, now let's understand why do we need accounting. Firstly, it is important for a business to organize financial information related to its business. So a business does many transactions every day, every month, but it also needs to have a track of where the money is coming from and where the money is going. So to have a track of the transactions that are happening, a business needs to do accounting to know whether the company is profitable or not. So when we do accounting, we'll know the financial condition of the company, whether our company is profitable or it is loss making. So to know the financial condition of the company, it is important to do accounting. To take further decision in the business, we need to have an idea of the financial condition of the company. So when we know the financial condition of our company, we can take further decisions in our business. So let's say our business is profitable. In that case, we can decide whether we want to increase the scale of production or we can expand the business in different sectors. Or if our company is loss making, in that case, we can take further action to reduce the loss and make our company profitable. So to know the financial condition of the company, we will make financial statements and take decisions based on it. So here we can say that accounting helps us to use the past in order to take action in the present and change the future. So now that we have understood what is accounting and why do we need accounting, let's understand a few basic terms related to accounting. Assets. Assets are resources with economic value which companies expect to provide future benefits. In simple words, we can say that assets are what we own. Examples: company land and building, furniture, inventory stocks, that is the goods which are there in your godown which you are going to sell and generate revenue, current assets, etc. Let's take an example of company land. So your company owns a land, and on selling that land, you can generate revenue. So the company land is an asset for your company. Now your company has few machineries and tools using which you manufacture a product and you sell that product to generate revenue. So the machinery and the tools which you have are helping you to get economic benefit by manufacturing the product. Hence, the machinery is also an asset for you. You can either use that machinery to manufacture products and generate revenue, or you can directly sell that machinery and generate revenue. So machinery is an asset for you. So now we can say that assets are resources which a company owns and are valuable because they can generate revenue or can be converted into cash. Next, liabilities. We can say that liability is completely opposite to an asset, where asset is something which we own, whereas liability is something which we owe to someone. Liability is an obligation of an entity where he or she owns someone else an economic benefit due to some past event. Example: bank loans, accounts payable, salary payables, tax payables, etc. Now let's say in the past you have taken a bank loan. You do not own the money which you have taken from the bank and you have to pay it back. That is, your company is liable to pay back the amount to the bank. Hence, it is a liability for your company. So we can say that liability is when one entity owes money or an economic benefit to another entity due to some past event. Next, expenses and revenue. First, let's understand what is expenses. An expense is the cost of operations that a company incurs to generate revenue, or we can say that expenses refer to the cost of operations of a business. Let's say you're a laptop manufacturing company, and to manufacture that laptop, you have to buy the raw materials. So, the cost of the raw materials is an expense for you, and now transporting the raw materials from one place to another, that is also an expense for you. You also need electricity to do your job. So, electricity bill is also an expense for you. So, we can say that expenses are the cost a company incurs to generate revenue or to run its day-to-day operations of its business. Next is revenue. Revenue is the gross income a business makes through its normal business operations. So now we have manufactured the laptop. When you do the sales of the laptops you have manufactured, you will get some money from your customers. This money which you have got from the customers for doing your sales is the revenue. So revenue is when we get money from an entity, whereas expense is when we pay money to an entity. Do not confuse revenue with profit. Profit is what you get after subtracting revenue from expenses. Revenue is the money which you have got from your customers for doing the sales. But to manufacture this product, you also had some expenses. So when you subtract revenue and expense, you get your profit. Next, accounts payable and accounts receivable. Accounts payable. Accounts payable refers to the money a business owes to its suppliers, vendors, or creditors for goods or services bought on credit. So now let's take the same example that you are a laptop manufacturing company. You have bought the raw materials from your supplier on credit. That is, the supplier will give you the raw materials now, but you will pay the money later. So the money which you have to pay back to your supplier is known as accounts payable. You buy the products from your supplier on credit and you will pay this money back to your supplier. The money which you have to pay back to your supplier is known as the accounts payable. It is a short term debt that must be paid back quickly to avoid default. Accounts payable shows up as a liability on an organization's balance sheet. Accounts payable is a liability for the company because we owe money to our suppliers. Since we owe money to our suppliers, it is a liability for us. Next is accounts receivable. We can say that accounts receivable is opposite to accounts payable. In accounts payable, we are liable to pay money to our suppliers, whereas in accounts receivable, our customers are liable to pay money to us. That is, our customers have bought products on credit from us and will pay back to us later. The money which we have to receive from our customers in future is known as accounts receivable. What is capital? Capital refers to an organization's financial assets, or in simple words, the money invested in the business. So, to start a business, the owner of the company invests some money into the business. The money invested in the business is known as capital. And for a business to run its day to day operations, it needs some money. And this money is known as the capital of the business. So, in simple words, we can say that capital is the money invested in the business and it is the money which the business uses to run its day to day operations to generate more revenue and make the business more profitable. Next is creditors and debtors. First, let's understand what is a creditor. A creditor is an entity, company, or a person that has provided goods or services to another entity who is the debtor. So now let's again take the example that you are a laptop manufacturing company and you need to buy the raw materials. The person who is going to supply the raw materials to you is your creditor and you have to pay money to him. In simple words, we can say that a creditor is a supplier or vendor who is going to sell his products or service as their business. Next is debtor. We can say that a debtor is completely opposite to a creditor. A debtor can be an entity, a company, or a person of legal nature that owes money to someone else. That is, he owes money to the creditor. So now you're the debtor. You are going to buy raw materials from the supplier. So the supplier is the creditor who sells his products to the debtor, and you are the debtor because you owe money to the creditor. So in simple words, we can say that the debtor creditor relationship is similar to a customer supplier relationship where the creditor is a supplier and the debtor is a customer. So now that we have understood many basic terms of accounting such as assets, liabilities, creditor, debtor, etc. Now let's understand what is profit and loss account. Profit and loss account is also known as the income statement because it shows the income of the company in a specific time period. A profit and loss account is a statement which shows the expenses and the revenue for a company during a specific time period. In a profit and loss account, one side you have the expenses and on the other side you have the revenue. On the expenses side, you will have all the expenses and costs which have incurred for the company during the specific time period. And on the revenue side, you will have all the revenue which you have got from your customers after doing the sales. It shows the performance of the business, that is, the profit earned or loss incurred by the business. So, how do we know whether our business is performing well or not? When a business is making profit, we can understand that the performance of the business is good. And if we are incurring loss, we can understand that a business is performing badly and we have to take necessary action. So when you subtract the revenue and the expenses, you get your profit or loss. If your revenue is more than the expense, then you're in profit. And if your revenue is less than the expense, then you're in loss. Balance of P&L account is transferred to the balance sheet. So when you subtract revenue and expense, if you're in a profit, so the profit is generally reinvested into the business so that we can make the business more profitable. Since it is reinvested into the business, capital of the business will increase. That is, the money which the business has will increase. And since capital comes in the balance sheet, we say that the balance of the P&L account is transferred to the balance sheet. So what if we are in a loss? When our company is in a loss, that means we have lost money. So the capital of the company will decrease. That is, the balance sheet will again be affected. So the balance of the P&L or whatever happens in the P&L will always affect the balance sheet. So now let's understand what is balance sheet. The balance sheet is a financial statement that reports a company's assets, liabilities, and equity. The balance sheet is divided into two parts. On one side, you have the asset, and on the other side, you have the liabilities. The liabilities include the liabilities of the company and the shareholders' equity or the money invested into the business by the shareholders. And in the balance sheet, the asset side and the liability side will always be equal. That is, if the assets are equal to 100 rupees, the liability side will also be equal to 100 rupees. The balance sheet is always balanced. So from this, we get the general balance sheet equation, which is assets is equal to liabilities plus equity. The balance sheet provides a snapshot of what a company owns and what it owes, as well as the amount invested by the investors. So on one side you have the assets which the company owns, and on the other side it has the liabilities which the company owes to someone else, and also the amount invested by the investors into the company. That is the shareholders' equity. So to get the net worth of a company, you will subtract the assets and the liabilities of the company. Next is investors and analysts use the balance sheet to calculate various financial ratios before investing in the business. So before investing in a business, the investors need to know the financial condition of the company and whether the company will be profitable or not in the future. So to know that, the businesses use the balance sheet of the company where they prepare multiple financial ratios based on the financial information they have and will take further decision whether they should invest in the business or not. Now let's understand balance sheet with a small example. The balance sheet is in a T format where one side is the assets and on the other side we have the liabilities plus the equity. Both the asset side and the liability side will always be balanced. But you might have a doubt over here that why is equity or shareholders equity on the liability side? Because it is the money company owns, so it should be on the asset side, right? So why is it on the liability side? The reason is that the business or the company is always liable to pay back this amount or the amount invested by the owners into the business. The company is always liable to pay back this amount to its owners. Hence, it is a liability for the company. So, equity will come on the liability side. So, let's say you have invested 100 rupees into your business. So, your cash will be 100 rupees. That is, your assets will be 100 rupees. Your liability is zero because you do not owe any money to anyone. But your shareholders' equity, that is the capital of your business, will be 100 rupees. Hence, the balance sheet is balanced. So let's say you use all this 100 rupees cash to buy few products and do sales and generate profit. So now your inventory value is 100 rupees. You have bought goods worth 100 rupees, but your cash will be zero now because you have used up all your cash to buy these goods. So now your products in your inventory will be an asset for you because on selling this, you can generate revenue or economic benefit. Hence your asset side is 100 rupees, your liability side is 100 rupees. Again, the balance sheet is balanced. Now let's say you sold this goods worth 100 rupees for 500 rupees. So now you have total cash of 500 rupees, in which 100 rupees was the cash you invested. You sold it for 500 rupees. So your total profit is 400 rupees. And the total cash you have is 500 rupees. But now the balance sheet is imbalanced. The asset side is 500 rupees. The liability side is 100 rupees. But the balance sheet should be balanced, right? Generally, in businesses, the profit which the business has earned is always reinvested into the business so that we can increase the scale of the business and make the business more profitable. So the capital will not be 100 rupees. Since the profit of 400 rupees is reinvested in the business, now the capital will be 500 rupees. 100 rupees was the original capital, 400 rupees was the profit which was reinvested in the business, and hence the capital is 500 rupees. Hence, the asset side and the liability side both are balanced. So, I hope you understood what is balance sheet by this example. In this video, we learned what is accounting, why do we need accounting, and a few basic terms related to accounting. That is it for this video. Thanks for watching. Meet you in the next video.